What if I told you that the biggest risk in the US stock market right now is not that AI technology will fail, but that AI companies will be too slow to turn a profit? Would you think I'm crazy? For the past 3 years, every investor has been arguing about one question: is AI a bubble? That question is already outdated. The real question now is, even if AI ultimately succeeds, why could it still become the starting point of the next major correction in the US stock market? The answer is simple. Technology can take a decade to change the world, but the capital markets may only give companies 2 or 3 more quarters from now on to prove themselves. Money doesn't care about whether AI technology works. It only cares about when AI technology will generate profits. Today, the story of the AI revolution has already been priced into those stocks' prices, but the profits haven't arrived yet. In this video, we'll dive deep into why the AI sector in the stock market faces a bubble-bursting risk, how individual investors can respond, and whether there are stocks beyond AI that you can position in early to hedge against risks and potentially capture returns. Many people look at one metric to judge whether AI stocks are expensive: the forward price-to-earnings ratio. And one thing interesting is, even though the S&P 500 has risen a lot, its forward PE hasn't gotten more expensive. It's dropped from about 22 times to about 20 times. Why? That's the first bubble. AI-related stocks are already very expensive in price. At the same time, Wall Street keeps raising its profit forecasts for these stocks. The second bubble is more hidden. The earnings forecasts that justify those high prices are themselves at historically elevated levels. In the second quarter of 2026, the market expected S&P 500 earnings growth to exceed 23%. That's certainly possible, but it raises the bar for market validation to an extremely demanding height. Companies now face not just are we making money, but also are we making money as fast as big money expected? If profits are still growing, but only at a normal pace rather than beat expectations, the stock can still tank. Because stocks don't trade on good or bad, they trade on the gap between reality and expectations. That's the real danger of the double bubble. Stock prices rise because earnings expectations rise. Earnings expectations rise because everyone believes AI will commercialize quickly. Once that chain breaks, the market will cut both earnings forecasts and valuation multiples at the same time. That's not a 10% correction. That's a multiplicative effect from 2 variables contracting simultaneously. AI has evolved from a technological revolution into a massive infrastructure project. Tech companies are buying GPUs, building data centers, signing power contracts, expanding networks. Companies that used to be asset-light software firms are turning into asset-heavy infrastructure builders. But the reason capital markets gave them high valuations in the first place was precisely because AI was supposed to bring cost reductions. Now the question has changed. For every dollar invested, how much new profit can actually be generated? Over the next year, the market will stop caring about who bought the most chips. It will only care about 4 things. 1. Can AI revenue growth outpace capital expenditure growth? 2. Are gross margins being eaten by electricity costs, depreciation, etc.? 3. Is free cash flow still growing? 4. Can management clearly explain when the money will be earned back? Micron is a mini stress test. Its stock soared because of surging demand for AI memory, but then quickly pulled back after hitting new highs. The market isn't denying AI's demand for memory. It's just asking tougher questions. How long can high prices last? Will supply catch up? Will customers start pushing back? The market has shifted from believing in demand to demanding proof. First, companies had to prove the technology works. Then they had to prove customers would pay. Now they need to prove that this business can actually make money. Today's US stock market has already priced in the success of that third stage. But companies' operating results are still somewhere between stage 2 and stage 3. So we won't see an overnight collapse of the AI bubble, but we will see a tiering. The story won't end suddenly, but the market will start to distinguish who is truly creating profits and who is just creating orders. Many people see index new highs and think they're making money, but what they don't see is the index's rise is increasingly dependent on just a handful of companies. And these companies all tell the same story: AI. This leads to a very strange phenomenon. Most stocks can be up, yet the index may still fall, because the weight of those few giants is too heavy. Conversely, even if most stocks are flat, as long as the giants keep rising, the index can still hit new highs. That's the trap of market breadth. Concentration itself isn't a reason for a crash, but when concentration is combined with high valuations, high leverage, and high expectations, the market forms a dangerous positive feedback loop. Weighted stocks rise, leads to index rises, leads to passive money buys more weighted stocks, leads to weighted stocks rise further. At the same time, borrowed money used to buy stocks has piled up to historic highs. When the market goes up, this money amplifies the gains. But when prices fall, the same mechanism forces funds to cut positions, dealers to adjust hedges, and investors to meet margin calls. A seemingly ordinary earnings report could turn a routine pullback into a liquidity shock, and the trigger might just be a single piece of news. A mega cap still growing, but lowering its AI return expectations. A chip company still profitable, but order growth starting to slow. Once the market realizes that previous profit growth rates were overestimated, the bubble becomes visible. Based on these three structural issues, I have 4 predictions for the next 12 to 24 months. First, AI stocks won't collapse directly, but will enter a phase of high volatility, strong differentiation, and repeated verification. Every earnings season will be a trial. Second, semiconductors and memory will reflect changes in ROI earlier than large platform companies because they sit at the very front of the capex chain. Stocks like Micron could become leading indicators for the entire AI capital cycle. Third, we'll see index stability with internal rotation. When AI takes a breather, money will try to flow into industrials, financials, healthcare, etc. But for this rotation to signal real risk reduction, we need to see genuine improvement in earnings expectations for those non-AI sectors, not just a brief catch-up. Fourth, if over the next 2 to 3 quarters we see 3 signals at once, AI leaders forming lower highs, the equal-weighted index persistently underperforming the cap-weighted index, and earnings forecasts starting to be cut, then the double bubble will turn from a theoretical risk into a tradable downside trend. Conversely, if AI revenue starts outpacing capex, free cash flow expands again, and other sectors' earnings pick up the baton, then the market could digest valuations through earnings growth rather than via a crash. I'm not predicting a crash, I'm predicting an increasingly rigorous financial audit centered on return on invested capital. Risk warnings are just another form of entertainment if they don't change your portfolio. Here are 5 actionable steps you can take right now. First, check your hidden AI exposure. Holding an S&P 500 ETF, a NASDAQ ETF, a semiconductor ETF, plus a few tech stocks, that's not diversification. That's betting on the same risk across different accounts. Look through all your funds to their top 10 holdings and calculate your total AI-related weight. Second, stop using leverage to compensate for return anxiety. Margin loans, triple leveraged ETFs, single stock leveraged ETFs, short-term options, they create quick profits on the way up, but on the way down, they turn should I sell into I must sell. Third, restructure your portfolio into 3 layers, 40% to 50% growth layer. Keep core AI assets. Don't abandon the trend entirely. 25% to 35% cash flow layer. Add companies with real pricing power and proven cash generation. 20% to 30% defense and opportunity cash, short-term bonds or cash, to weather volatility and to buy when prices drop. Fourth, set up 4 weekly technical checks. Cap-weighted S&P 500 versus equal-weighted S&P 500. Whether the semiconductor index holds above its 20-week moving average. Whether AI leaders can hit new highs after good earnings. Whether down-day volume consistently exceeds up-day volume. Fifth, don't mistake defensive for buying low volatility stocks. True defense means revenue that won't vanish in an economic slowdown, ability to pass through cost increases, free cash flow sufficient to cover debt, dividends, and necessary investments, no reliance on large-scale refinancing in the next 2 to 3 years. Right now, your portfolio should not have just one answer. Today's US stock market is not a simple AI bubble. It's more complex than that. The technology is real, the demand is real, and profits may continue to grow. But the market has already extrapolated these real trends into an extremely high speed of success. What ordinary investors really need to do is, while the market still offers liquidity and high prices, reduce overlapping risks, cut leverage, increase sources of cash flow, and keep dry powder for the next repricing of valuations. In the next 4 episodes, we'll do a deep dive into 1 company per episode. Next time, we'll look at a company that doesn't build large language models, nor does it sell GPUs, but any AI player wanting more computing power cannot bypass its products. Is it a true long-term infrastructure winner, or has it already been priced too richly by the market?